Good afternoon, everyone, and welcome to KTrade's webinar. This week, we are excited to be hosting someone I've known for a very long time, Ruchir Desai. He is co-fund manager of the AFC Asia Frontier Fund based in Hong Kong. I've known Ruchir for a very reasonable amount of time. He's been with the firm since 2013. We've had very extensive conversations on Pakistan's macro politics, sectoral themes, and companies over the years. Obviously, I will let Rashid introduce the firm and obviously their multi-market and country-specific strategies. But by way of background, for anyone who's ever spent time looking up frontier markets, you will definitely come across Rashid's views on frontier markets in general, and I think that serves as a testament to his experience in these markets. We'll be discussing a host in a range of topics covering Pakistan's reform process, the outlook which foreign investors generally perceive as far as the progress on our reforms are concerned, as well as market sentiment, and then what else we can do to play our part to further bring back foreign investment in the country and make sure that those levels are maintained. So Ruchir, thank you so much. I understand it's end of day in Hong Kong. Thank you for taking out the time for us, and hopefully we won't keep you too long. But if you can start with a brief introduction to yourself, that would be great.
Great. Thanks, Naveed, and good afternoon, everyone. Good evening, I guess, Pakistan also. And very happy to be here and very nice to talk to Naveed and also all the participants, and good to talk about Pakistan, also frontier markets. So I'll just talk a bit about myself and also Asia Frontier Capital. So as Naveed suggested or mentioned, Asia Frontier Capital invests in listed equities in frontier markets in Asia. So obviously invest in Pakistan, but also in other markets like Vietnam, Bangladesh, Sri Lanka, Kazakhstan, Uzbekistan, and other frontier markets in Asia. So we were formed or established in June 2013. So I've been with the firm since day one, and I've been covering pretty much all these markets, including Pakistan, for almost 11 years now. So I've seen the cycles in Pakistan and also the other markets over the past decade. And that's what we focus on. And I'm the co-fund manager of the AFC Asia Frontier Fund, and I predominantly cover Bangladesh, Pakistan, Sri Lanka, Vietnam, Kazakhstan, and Georgia. And I know what's going on in the other markets as well, but I spend most of my time on these markets. And I've been spending more time on Pakistan of late, given the fact that the market has been recovering and the economy also has kind of bottomed out, I would say, last summer. So it's been a pretty good ride for Pakistan over the past 1 year, and I'm quite hopeful that the returns can be sustained, not just this year but also going forward as well. So that's a bit about me, and you can take it from there, Naveed.
Perfect, great. Thank you so much. For the audience, if anyone has any questions, please put them in the chat box and we'll try to get Ruchir to answer them for us. But Ruchir, for us to get started, if you can share, I think a lot of the audience wants to know how the frontier landscape has changed over the last 5-7 years since Pakistan was last a frontier market in terms of investability, in terms of global asset allocation. So if you can talk a little bit about that, and then if you can tell us what kind of key global events or triggers that we need to look for that could potentially change that landscape as far as frontier markets in general are concerned.
Yeah, I think a couple of important factors about investing in frontier and emerging markets that have taken place in the last probably 5 or 6 years. So one is, I think, a very important point, not just for frontier markets, not just for Pakistan, but I think the broader emerging market asset class as a whole. If you look at returns from the US over the past 5-6, even past decade, basically, especially for the past 5 or 6 years, it's completely outperformed everything else, right? So even if any emerging market, which, for example, it's outperformed even India, I would say, to some extent. So it's as an asset class, the US has outperformed pretty much every other asset class, like emerging markets or other developed markets also. So a lot of flows have moved from frontier and emerging markets into the US over the last few years, given strong performance from the US market. So that's been a big driver for, I would say, outflows from frontier markets in general or emerging markets over the past few years because of outperformance by the US, and also some underperformance and some structural issues in frontier and emerging markets, like we've seen some issues over the past few years. That's one. Second is, I think, what happened post 2022, especially post the war in Ukraine, with high commodity prices, high food prices, high inflation, etc. As plus the US being so aggressive that I think it's the most aggressive US interest rate increase that we've seen probably in many decades, going from 0% to basically 5.5% in a span of probably 18 odd months. So that was very aggressive, and when the US Fed raises interest rates so aggressively, that's very negative for emerging and frontier markets in general. We know that that's a historical fact. But I think what made it more negative was the fact that you had inflation at such high levels, plus you had the war in Ukraine. And more importantly, I think many smaller emerging markets and frontier markets like Bangladesh, Pakistan, Sri Lanka, and some other African frontier countries, they went into 2022 on a very weak economic footing, right? So macro was quite weak. You had rising current account balances, you had low FX reserves, reforms didn't take place. In the case of Pakistan, the IMF discussions, there was no IMF deal which was being finalized until when the war in Ukraine happened. So many of these countries went into 2022 before the war in Ukraine on a very, very weak economic footing. And on top of that, you had the war in Ukraine, which led to high inflation. On top, in addition to that, you had the very aggressive US. So that was a big negative for many of the emerging and frontier markets. So I think that was a huge setback for the asset class, because you had people going to safety like the US, and anyway US was outperforming on a longer term basis anyway. So you had a lot of outflows, and a lot of people lose confidence in the frontier markets or in general emerging markets over the last few years. And I think just to add to that, what's happened in China, and especially in the last 2 years, China has been a big underperformer, especially post 2022, the zero COVID, and especially with the geopolitical tensions between China and the US. That's led to underperforming in China as well, and that's also led to because China is such a big asset class, so such a big market in the region, that's led to kind of negative perception or negative sentiment towards emerging markets in general. So I would say, one is the outperformance by the US over the past decade. That's been a negative for frontier emerging markets, and two is 2022 onwards, many economies suffered significantly because of the aggressive US Fed and high commodity prices, plus China underperforming. That's led to kind of underperformance from frontier. So that's the past. But I think now what we're seeing, in my view personally, for example, for AFC Asia Frontier Fund and also for Asian frontier markets, 2022, I would say end of 2022, beginning of 23 was the bottom for the economies in our markets and for stock markets as well. So you've seen very strong performance from stock markets. Of course, Pakistan, like has done well, but Sri Lanka has done very well. Vietnam has done okay. Kazakhstan's done well. So our performance for our fund has been very strong over the past probably 15 or 16 months, at almost 40% over the past, since the beginning of 2023. Because things bottomed out end of 2022, valuations were so cheap. So now I'm from a foreign investor flow perspective, I think the tide has turned, because the economies in these in our universe have kind of turned around. And plus, I think more importantly, I think which is very critical, the US Fed will at some point start cutting. And even they don't cut, they've basically become less hawkish, or they've made some dovish comments, and that's led to more positive sentiment towards emerging and frontier markets. And also you're seeing some recovery in China. So broadly, yes, the last probably 5 years have been tough for especially frontier markets, but I see the tide turning now. And I would say, not just this year, I would stick my neck out and say next 2-3 years will be a very positive time, very good period for especially Asian frontier markets like Pakistan, Bangladesh, Sri Lanka, even Vietnam to some extent, because they're all coming out of a macro crisis, their own macro crisis, plus the global macro environment is improving from the US Fed perspective. So I'm very positive on these markets for next 2 to 3 years now.
That's great, and I mean that's very encouraging coming from you. I mean, based on your assessment, when do you start seeing rate cuts coming through? I mean, I know there's been a lot of talk of the US Federal Reserve cutting rates. There was talks earlier this month as well. And then obviously expectations have been starting to push out. In your perspective, when do you think we can start seeing the Federal Reserve cut rates at some point in this year?
Yeah, I think I think it's not easy to say when when the year began, people were expecting March or May. Then as the quarter ended, first quarter ended, they were saying June. Now they're saying December, or maybe not even any cuts this year, more next year. So I think we should not think about when they're going to cut, how much they're going to cut. I think we should think of the big picture. The big picture is inflation is coming off in the US. Yes, it's been sticky for the past 3 months, but if you look at the PCE inflation in the US is at for 2.7, 2.8%, and the target is 2%, right? So it's coming off. Take a more longer term view, it's coming off. So the trajectory is going downward. And the Fed also, there's been a concern that they'll keep high for longer, but the trajectory is going down. At some point they will cut, at some point they will get the chance to cut. So that's the big picture. That's been very positive for the market. So the market looks ahead. So, and that's why you've seen a rally also, in the past couple of weeks in the US, especially on the Nasdaq and the S&P, because the market expects that, maybe, they may do one cut, they may not cut, but at some point they will cut. So that's very positive. So I think you should keep that in mind instead of thinking about when they're going to cut and how much they're going to cut. So the trajectory is positive, basically.
Understood. In follow-up to Frontier, obviously Vietnam has done relatively well. Economy is growing like clockwork and foreign interest remains high. Obviously, there's some news flow coming in that Vietnam could potentially be upgraded to an emerging market. Based on what we understand, that obviously there's some conditions regarding Vietnam that need to be looked at or changed. I think that pertains to foreign ownership limits, and that pertains to pre-funding of trades. But I mean, assuming something happens for Vietnam in terms of an upgrade, do you see a timeline for that happening? And if so, what kind of impact do you think that's going to have for those markets that are left in the frontier space like Pakistan?
Yeah, I mean, so for Vietnam's upgrade, I mean, there are two upgrades which people are talking about or which potentially could happen. So one is the FTSE Russell upgrade to emerging markets, and the other is the MSCI emerging markets upgrade, right? So you have to take them separately. So one is the FTSE Russell.
Right.
Now, for that, FTSE Russell probably is less strict, I would say, than MSCI. So, for example, as you know, Vietnam has the foreign ownership limit on many sectors and many stocks. So, for example, there are foreign ownership limits for banks, for ports, and some other sensitive sectors. So, foreigners can't own more than, say, 30% in banks or more than 49% in retail companies or in port companies. So, once that stock hits the foreign ownership limit, you and I cannot buy that stock. So, if you run a Vietnam fund, you want to invest in Vietnam, you cannot buy that stock freely in the market. You have to pay a premium. If there's another foreign seller, you have to pay a premium to that stock price, 7% premium, 8% premium, whatever it is. So that's not a fair market to foreigner, right? So compared to, say, Pakistan, I can easily buy Lucky Cement without paying any premium, even though everyone is treated equally. But in Vietnam, for these stocks which have foreign ownership limits, the foreigners are not treated equally because they have to pay a premium to buy those shares in case they want to buy it. So that's a big drawback, and that's a very big drawback for MSCI, because MSCI wants equal treatment for all investors, domestic and foreign. So for Vietnam to get upgraded to the MSCI Emerging Market Index, they would have to do something about the foreign ownership limit, which is a big drawback for MSCI. And for Vietnam to remove the foreign ownership limit is a huge process. It's a very bureaucratic process. Right. Because as we know, Vietnam is a one-party state. It's very bureaucratic. Things don't happen like overnight. This goes through many levels of bureaucracy. Plus, there are many ministries involved, right? So, for example, for the banking sector, there's finance ministry or the banking ministry or whatever. Then for the port industry or Ministry of Transportation. For the other industries, you have some other ministries. So they all have to give the okay. Then the okay, so many levels of bureaucracy involved in that, and it's also a very sensitive topic for the government as well, right? So maybe do they really want to open up all these sectors to foreigners, because given the fact that they also want to protect their own industries and protect their economy and stuff like that. So it's not going to be easy. It's not going to happen in the next 1 or 2 years. That's my view. And so what you hear about Vietnam being operated by next year is about the FTSE Russell. So that could potentially happen. But let's see. For that, FTSE Russell is not so strict about the foreign ownership limit. For them to upgrade Vietnam to emerging markets, Vietnam has to remove pre-funding. So Vietnam also has this pre-funding kind of deal criteria where before you buy shares, you have to basically check with your broker that the cash is there. Or if you want to sell shares, you ask your broker to check with the custodian whether the shares are available to sell. So that's pre-funding, basically. If they remove that, then yes, the upgrade will happen. But the point is, when will they remove it? So FTSE Russell, the upgrade, they make the announcements in September. So we are in May now. So Vietnam has to remove it basically in the next 1 month, pre-funding the next 1 month to get the upgrade announcement by September. So let's see. But coming back to your question, if that happens, yes, it'll be positive from a sentiment perspective. Because the market will build up the stock about emerging market upgrade and stuff like that. So yes, there'll be some positive sentiment. But fundamentally, the FTSE Russell is a much smaller index, compared to the MSCI. So the amount of AUM that is tracking FTSE Russell EM is much smaller than MSCI EM. So the flows will come in, but MSCI is really the big deal. So yeah, it's positive, but I mean the huge positive will be MSCI, and that I don't see happening for quite some time.
Great. Sticking to Vietnam, I mean, obviously, they've done exceptionally well to take advantage of obviously changes in geopolitics in terms of establishing itself as a manufacturing destination for the region. If you can share some, reform processes that they undertook to position themselves in that area, and potentially what areas you see that are similar that Pakistan can potentially capitalize on. The reason I'm asking this question is because a lot of the audience members, obviously on this call, are people that could potentially take, a thought process ahead. And if that's possible, we'd like that to happen. So if you can share some thought processes on what Vietnam did in terms of positioning itself as a manufacturing hub for the region, and where we draw similarity, what we can potentially do to capitalize on those opportunities.
Right. So, I mean, if you look at Vietnam's manufacturing success story, it's not happened overnight in the past. A lot of people have been talking about it, especially in the last few years, given the tensions between China and the US and many, companies moving the manufacturing operations from China and the US. But it's not a success that has happened in 2 or 3 years. It's taken time. So Vietnam has built up the manufacturing sector over the past probably 2 decades or so. And of course, like everyone else, they started off small. But I think what's been positive or what's helped them is their geographic location. They're close to China, so when Chinese companies were and are looking for manufacturing locations with low wage costs, I mean Vietnam is right there. Shares a border with China, and also is very close to all the Asian supply chain links like Taiwan, South Korea, Japan, and also of course China. So shipping and all those things, it makes it much easier. So they started off small doing garments, footwear, t-shirts, stuff like that. But that's how even the other countries in Asia began, right? So for example, South Korea, Japan, Taiwan, Hong Kong, and even China, they all began doing lower end stuff, basic t-shirts, toys, stuff like that. And then they move up the value chain. So you have to start somewhere, and that's how Vietnam started. And now they've moved up the value chain. Of course, they're not doing. You can't really compare what Vietnam does towards say some what Nvidia does or some high-tech company does, but they do mobile phone assembly, laptop assembly, iPad assembly. The airports are also assembled in Vietnam. So it's been an evolution, right? So over the past few decades, that's how they built up that capability. And they've attracted the foreign investors into Vietnam, not really because of low wages, but one important thing is Vietnam is like I said, it's a one-party state. So land acquisition is not that difficult compared to, say, for example, India wants to do manufacturing, right? So getting land in India is not easy. Vietnam's labor policies are much more foreign investor friendly compared to, say, some South Asian countries. Plus, they give the tax incentives. So all those things have kind of built a very strong ecosystem. So because they have a kind of one-party state, they can get things done. Acquiring land, pretty good labor policy, getting things done in terms of paperwork and bureaucracy, giving the tax incentives, building the industrial parks, improving the infrastructure. It's similar to what China did basically 25, 30 years ago. So it's a similar model, or on a smaller scale, of course, because Vietnam is a much smaller country than China. The exact same thing what China did 25 years ago, Vietnam is doing the same thing now. But of course, their political system helps a lot. Their geographic system helps a lot. Their workforce is very disciplined. You have lower wages than China. So it's all come together. And they built up this capability over the past 15, 20 years. And now, because what's happening between China and the US, they've built up, they're the right place at the right time. So I think they've really, kind of have very strong advantage for manufacturing exports in Asia. And they've done very well. In terms of what Pakistan can do, I mean, one, obviously, like I mentioned, political stability. Vietnam is very politically stable. So investors don't take they're not like stock market investors. They don't take a 1-2 year view and get in and get out. They take a more 10, 15, 20 year view on when they want to manufacture or put up a supply chain or for mobile phones or TVs or even footwear or garments in a country. So they take a more longer term view. And for that, you need political stability. So, I mean, so Pakistan needs relatively more political stability than what it's had probably in the past 10, 15 years. That'll be a big plus. And I think if that can happen, everything else will fall into place, right? Because you have the labor force, you have the lower wages, and then you can, build pockets of expertise. So, for example, I think already some companies in Pakistan are doing mobile phone assembly and TV assembly for some Chinese brands, right? So you can build on that. You have to start somewhere. I mean, Pakistan already is strong in garment exports and textile exports, which, by the way, still has not met its potential, given the fact that Bangladesh now exports almost $50 billion of garments a year, and
Right.
Pakistan's about, I think, 20 billion. So I think that then the government policy also have to come into play, and that comes down to political stability, right? Stability, right? If you don't have political stability, how will you have stable policies? How will you attract the investors? So I think that comes down to that. I mean, the other things will fall into place if you have that stability, relative stability. So you don't have to become like a Vietnam, but you can have relative stability, and then other things will fall into place. And plus, I think Pakistan geographic location also, I think even the Pakistani kind of policymakers have spoken about this in the past, because you have the geographic location, you can connect your manufacturing activity to supply to Central Asia and other parts of the Middle East, which is a huge opportunity, right? So that's not happened as yet. So if you have that political stability, you can start with, you can start small, you can start somewhere, and then you can build up that supply chain to exporting to or supplying to Central Asia, which also, by the way, is doing quite well. Their GDP growth is, countries like Kazakhstan, Uzbekistan, etc., are doing quite well. They're also growing. Middle East also is doing well. So you can, you can really capture that opportunity. But for that, you need political stability. So the bottom line is, wage costs and getting land and electricity, that's very good, but the most important is political stability, or at least relative political stability compared to what you had in the past 10 years.
Great, thanks a lot for that view. I mean, obviously sticking on Pakistan, a lot of the high frequency data that has been coming in from a macro perspective, at least we believe that this is starting to show some stability. It's starting to indicate that the economy is past trough. How are you viewing the data? How are you viewing the current phase of stability that we feel that we're obviously experiencing? Are the data points pointing to a potential U-shaped recovery? What are your thoughts on the data? I'm sure you're looking at all of the data sets. I know we've discussed each of them in the past. So if you can share your thoughts on the recent postings that you're seeing in terms of inflation, manufacturing, overall reserve position, the PKR stability versus the dollar. If you can share some thoughts on the high frequency data sets that are coming in.
Yeah, I mean, if you just look at the historical kind of record of Pakistan's economy, I mean, I guess you also, it's been like a boom-bust cycle, right? I mean, you had that in 2013, then you had some recovery, then you had 2018, 2019, you had a bit of a recovery, and then from 22 onwards and stuff, right? So I would say the economy bottomed out probably summer of last year, especially when there was talk of default and all those things, and there was political noise, stuff like that. Inflation was at 30%. But the cycles turn. So I think the cycle turned summer of last year. So I mean, just put from a market, from an investor perspective, I think first half of last year, Pakistan was extreme. I mean, I'm not saying it's not, it was extremely cheap. It was like very ignored. People had kind of written it off, talk of default and very high inflation. I think that was the time to basically buy Pakistan, buy some quality names in Pakistan, because that was the bottom in Pakistan. And things then did turn around. We saw a very strong rally in second half once the initial the standby IMF program came in. And then I think coming to your question about indicators, yes, inflation is coming off. And I think it'll come off even more because the high base effect starts coming in. Plus, you had very restrictive monetary policy, which will also play a positive impact on inflation. So those will be very positive for, in general, the economy, also for stock market sentiment. And eventually you will start seeing, the earnings also recover more strongly. I think earnings have been pretty okay for many larger companies in Pakistan. But broadly for the market, we'll see earnings recover as well, especially from first half of 2000 CY 2025 because of the lower interest rates coming in plus the low base effect. So that'll be overall positive. So I think, I mean, if you look at the other indicators, for example, auto sales are still pretty sluggish. Cement sales are kind of okay, mainly being led by export of cement. And even industrial, the IIP data is kind of still soft. So you still need some time for those numbers to, I mean, they're better than what they were probably 6 or 9 months ago. But you still need to see those to see a good recovery. For that, you need the interest rates to start coming off. And that's why I think second half, probably SBP will cut interest rates and maybe even more on first half of next year. So I would say 2025 should be a pretty strong year for in general for auto sales, cement sales, for the broader economic recovery. But that's also what happened, for example, in Sri Lanka, right? So Sri Lanka, the economy bottomed out end of 2022, first quarter 2023. Central banks are cutting interest rates there in June 2023. They cut by 700 basis points now in the last 1 year. And now you're seeing a recovery. So, for example, it's only in the fourth quarter of 2023 they showed about 4.5% GDP growth, and you're seeing earnings in the first quarter of this year recover. So it's a lag effect. So you have to give it some time. So that's why I see maybe 2025 calendar year being pretty good for Pakistan's economy overall.
Well, okay. We've seen a tremendous performance on the market in the past 9 months or so, and a lot of this performance has been built on or anchored on the realization that the Saudi investment is coming in. And there have also been a lot of work being done locally to remove roadblocks, regulatory roadblocks particularly, in order for this to flow through. And obviously, this has an element of the government and private companies as well. Do you see this materializing going forward?
I mean, I've read the news about Saudi investments and all the meetings between Saudi and Pakistani officials. I mean, okay, from an investor, this is how I look at it. Well, because we invested in Pakistan, we actually increased the allocation in the past probably 6 months. The way I look at it is, I mean, the Saudi stuff investment, it'll be a positive, a long-term positive for Pakistan. What happens, that's a bonus. And of course, the government should work towards that because they need the FDI, they need the reforms, etc. But I think from a more of a 1 year, 2 year perspective, like I mentioned, the economy bottomed out probably summer of last year. Now interest rates have peaked out, inflation is coming off. It'll come off even more. And then at some point, once I think the SBB only held off on cutting interest rates because of the IMF program. Otherwise, I think they would have cut in April because inflation is at like 17% and your interest is at 22%. So I think there's room for a cut, in my view. And inflation will come off even more. So I think I guess because of the IMF program and the talks are going on, they kind of held off, etc. Possibly with the budget, there could be some inflationary kind of measures. So that's why also they held off. But in general, that, like I said, the trend is even similar to the US, same story. The trend is moving down. Trend is in the right direction. So at some point, SBB will have room to cut. And therefore, they'll start cutting and you'll see interest rates being cut in my view, pretty aggressively if you take a 12-month view. They won't be at 22%. They'll probably be at, I don't know, in my view, 15% in the next 12, 15 months. So that's, in my view, very positive for market sentiment. And that's positive for overall economic growth. So from that angle, from my angle as an investor, that's what I'm looking at in the next 12 to 18 months, which is positive in my view. And that's why we've increased allocation to Pakistan. We don't increase allocation to Pakistan because of Saudi investment and what they're going to do and what kind of FDI they're going to make. Yeah, that's good if it happens. And it's a more long-term thing, which Pakistan has to work on. And that's something which investors will pay attention to probably in the longer term. Maybe once, suppose you have a strong rally in the next 18 months, interest rates come off, the economy recovers, then what is the next kind of positive trigger? What's the next, moment? What's the next kind of trigger or driver for, sustained GDP growth, sustained economic momentum? Then those things will start coming into play. So hopefully, I think that can add value to Pakistan's economy in the next couple of years.
All right. Just to play the devil's advocate a bit, as you mentioned, IMF is on the doors, on the cards, and we're discussing that, and there are meetings happening. A possibility of broad-based tax measures that are implemented, and probably hit aggregate demand a bit because of the price levels, right? So, do you? I mean, understand, as you mentioned, there's a gap and we're in the positive territory on the real interest rates. But do you feel that that can play out in somewhat slightly negative manner?
So you mean that SPP will delay the interest rate cuts? That's what it's suggesting because of the budgetary measures and IMF program.
Yes, yes.
Yeah, I mean, they already delayed, right? I mean, if you look at the April inflation number, there was room for the interest rate cut, but I guess they delayed because of the IMF talks. So you have to wait, I guess. But if you look at, if you move into, suppose we are moving to fourth quarter of 2024, I think or even second half of 2024, if and when the IMF program is done and the budget is passed, the inflationary measures, then yeah, I think especially in the fourth quarter of 2024, there'll be room for the SPP to cut. So that's why I'm saying the room will be there. And in my view, you could start seeing pretty aggressive interest rate cuts once these kind of uncertainties about the IMF and budget and inflationary measures are out. So the trend, again, like I said, is moving in the right direction. So if not in June, if not in July, if not in August, I think the fourth quarter also, I think there's a very high chance interest rates will be cut by SPP. And if you take a 12-month view, then interest rates will be cut quite aggressively. So this maybe the start in fourth quarter and then keep cutting in 2025. And that's why I'm, I think, positive on the overall economic outlook for Pakistan in the next probably 18 months and also the stock market. So I would take a more 12 to 18 month view on the whole interest rate cycle rather than taking a 3-month or 6-month view.
All right. You mentioned a couple of sectors, the auto sector, the cement sector, obviously based on the interest rate cycle that you're looking at going forward. Any other particular sectors that you may feel will also benefit going forward or are on your radar?
Yeah, I think historically in Pakistan, whenever interest rates have come off, they've come off pretty aggressively, and that's been very positive for the market, right? So yes, the market has rallied now the past probably 6 to 8 months, but then again, the valuations were so cheap and it was so discounted, everything was so negative, and you've had positive news flow the past 6 to 8 months. But I think the one important trigger has been the lack of interest rate cuts, which I think will be a big positive for just overall investor sentiment, because many investors are invested in fixed deposits or fixed income. And as interest rates start coming off, that'll be very positive for the stock market. And therefore, I think from positioning perspective, in terms of investments, cyclicals and interest rate sensitive sectors will, in my view, do well. So autos, cement, then the rally will be joined by, in my view, not just the large names in cyclical, but also I would say small mid caps. So some of the small mid cap names which are cyclical in nature, consumer facing or consumer discretionary facing, those will start doing well also. So you have some of the mid cap, small cap names trading at like 5 times, 6 times PE, have got debt on the books. I think they will also start rallying much more, in addition to maybe cement and autos. So basically, I think if I was an investor, I would have a probably slightly higher weight to cyclicals and interest rate sensitive sectors with the 12 to 18 month view.
Right. Before I just hand it over back to Naveed, I'll take a couple of questions from the chat box that we have, all the local investors that we have. What's your outlook on the currency in the next 12 to 18 months? And what kind of minimum target return that you guys look at when investing in fragile economies like Pakistan?
I mean, on the currency, I think the worst is over. So I don't expect Pakistan to see like a 30-40% depreciation like we saw in 2000, especially 2022, right? So I think the macro, Pakistan's coming out of a crisis, not going into a crisis. So for example, I mean, you can compare to say Sri Lanka as well. Sri Lanka saw a pretty big depreciation in 2022. Then they went on the IMF program. They saw an economic recovery, FX reserves improve, current accounts stabilize. So currency, in fact, is appreciated because of, they also get tourism inflows, etc. So I think a similar case for Pakistan can be made, because now they're coming out of a crisis. We have the IMF funds coming in. Your current account has stabilized, FX has improved. And as long as oil remains where it is, I mean, oil is something which is it could be kind of a downer in terms of oil. If oil really rallies, that's a bit of an issue. But besides that, if oil remains $85, it's manageable. So I don't see a major maybe 3, 4, 5% normal depreciation like for any emerging market economy that will happen, but not like what you saw, a significant depreciation like 20 or 30%. So that happens in a crisis, but Pakistan's coming out of a crisis, so I would say normal depreciation of 4 to 5%. And the second part of the question was return, right? So I think we don't look at a return just by country, but in general, we look, if you look at nominal GDP growth across some universe is about 8 to 10%. So that's about 10%. So that's we target about 10% annualized returns over the long term. So that's how we look at it instead of looking at by country or by specific country.
Great. Ruchir, I mean, in follow-up to obviously everything that we've been discussing, foreign interest has obviously picked up. We've had, relatively tepid inflows of about $130 million that have come in since July. Obviously, this is just a fraction of the number that we used to see a few years ago. In your view, I mean, outside of the macro and the stability, political stability that you mentioned, what do you think that we can do to further accelerate foreign investment into Pakistan and then be able to maintain that level of investment? Even if your suggestions are from an exchange perspective, please share your thoughts on that.
Yeah, so I mean, one is a couple of factors which can help Pakistan in terms of getting more foreign flows. So one is, I think, like I said earlier in my comments, that I think the cycle is turning for frontier and emerging markets now, given that they had a tough time in the last probably 3 to 5 years. So you have to give it some time. It comes with a lag. So you've seen that happen already, like you said, since July last year. It's improving. But if you take a 2-year view, I think you will see more flows coming in. That's from a broader asset class perspective, and therefore Pakistan should benefit as well. And two, I think many investors had a tough time in Pakistan, especially from 2018 to 2022, right? So, 18, you had that big depreciation, had a stock market correction. Then, 19, you had the IMF program. 2021 was slightly, because of the pandemic, interest rates came out, that was okay. But again, 22 was tough. So you basically 5-year cycle, if you look at the KSE index, has gone nowhere, right? And in dollar terms, especially, it's gone down. So that's a pretty big negative from investors who took a hit, right? So they maybe didn't have experience in investing in countries like Pakistan, so they kind of got burnt in the currency depreciation. So I think for Pakistan to attract more investors back, I think what they will look for is consistency. So yes, you had a good run right now in the last probably 8 months of the stock market. Once the economy starts recovering, one concern for investors, even for me, to be honest, is the whole BoomBus cycle, right? So you have this BoomBus cycle. This is the third BoomBus cycle you've had the last decade, basically. So once by end of 2025, once the economy is picked up some momentum, and if there are concerns, or if there are no concerns that the current account deficit is not again ballooning or the FX is not depreciating significantly, you don't have another macro crisis on the cards, probably in 2026 or 27, then you'll see the investors coming back. That's what they want to see. I think investors, they want macro stability, right? So I don't think so for me as an investor, Pakistan's valuation is so attractive, 4 times, 4.5 times, whatever, KC 100 index, Lucky Cement at 6, 7 times, etc. All Pakistan needs to do for the next, in my view, next 3 to 5 years, is maintain political and economic stability, and the investors will come. You don't have to reinvent the wheel. You don't have to over-experiment. You don't have to do 8% GDP growth. You don't have to hit it out of the park. All you need is some stability for the next 3 to 5 years. That's all you need to do. Just keep it simple. That's all investors want to see, because they are also looking for opportunities to invest. But if you invest today, and in 2026, again, you have to kind of figure out what's going to happen to current account, what's going to happen to the macro, what's going to happen to currency, then investors will get scared. That's what happened in the past 10 years. Right? People have got burnt in the past 10 years. Okay, we still invest in Pakistan, but even we had, we only side for all of 2022, we didn't do in one single trade in Pakistan. because of the macro. So you can imagine other guys sitting in the US or London who cover other emerging markets. For them to pay attention to Pakistan, there has to be consistency in the macro, especially in the macro and the politics, for 3 to 5 years. Then the investors will come back. Otherwise, you'll have investors coming in now, and the end of maybe 26, 27, 2026, 27, again, if there's a macro crisis, they'll get out again. And you'll have this cycle. So basically, the cycle needs to change, in my view. And hopefully the government realizes that if you want to attract not just stock market investors, but also long-term FDI investors, that cycle has to change. So that's, in my view, that's critical. So otherwise, Pakistan will miss the bus again, and investors will go to Vietnam and even Sri Lanka. They've got their act together. I mean, they were in a worse position than Pakistan in 2022, but they have recovered strongly. The stock market's done very well last year. It's up 25% this year. Third best performing market globally in dollar terms. Reserves have gone up significantly. They're doing a lot of reforms, and everyone's happy with them. So you're seeing that in Sri Lanka. So I think Pakistan should probably show some consistency for the next 3 to 5 years. Investors will come. It's very simple. They're not so concerned about the other parts of about security and all those things. So those are all, in my view, secondary. But as long as the macro and political stability for, I would say, at least 3 years, then the investors will definitely come back to Pakistan. Yeah, that's how I see it.
I mean, we have some questions. I mean, I'm sure some of the audience members want to take advantage of your experience and obviously working in Sri Lanka, Bangladesh, and other frontier markets. So we've got some questions from obviously representatives of our domestic institutions. Fawad, please go ahead.
Okay. Starting now that you was talking about Sri Lanka right now, why hasn't Sri Lankan central bank not reduced rates below 8.5% when the CPI is 1.5%? What is the bank thinking when the situation appears to be normalizing?
Yeah, I mean, they've cut by 7 basis points already, so that's pretty aggressive. So you have to also give it some time. They from June last year to probably April this year, they cut by 7 basis points. That's pretty aggressive. And inflation has only gone to 1.5% now for the month of April. So it wasn't at 1.5% for the last 6 months. It was at about 3-4%, then went to about 5%. And they do have some room, but I guess they're taking a wait and watch approach to kind of see the lower interest rate there play out in terms of playing out in the economy, in terms of economic growth and higher credit growth. And plus, I think they have room, right? So they've already cut 700 basis points, and they have room now if things, for example, if the Middle East situation stabilizes and oil prices don't shoot up significantly in the next 6 months or so, then they could have room to cut. But they've done the aggressive part already. So I don't see they won't cut 700 basis points more. They maybe cut 150, 200 more. They do. But they've done the most of it now. So, and that's helped the economy. That's why I'm saying stock market's done very well from my investor's perspective also.
Okay, so there's a lot of talk on the local front of our debt being restructured locally. What are your views on that, given the high dependence on the domestic banks?
I didn't get the question. What will be restructured locally?
Our local domestic debt restructuring.
Domestic debt restructuring, right. Yeah. I mean, I don't know whether it'll happen, right? I mean, from all the banks that I've spoken to, it seems like it won't happen, given the fact that they'll be big. I mean, it could be a big issue for the banking sector, right? If that does happen. So, but I mean, Sri Lanka had to restructure because they defaulted on the external debt. So they had no choice but to restructure the debt, domestic debt, because it was so unsustainable. But Pakistan has not defaulted, or I don't think it's close to defaulting even on external debt. So maybe that's a bit, I would not say far-fetched, but I think that's being too pessimistic.
There's one question that I just came across in the chat box, and it's something we were discussing before the webinar started. We've got a client asking, obviously you mentioned BoomBus Cycles, and we've had, at least 3 in the last 10 years. Do you believe that this time around things are different, or is it premature to say?
I mean, if you look at what's happened, like I said, in the initial part of my comments, 2022 was many of these, basically all this, Bangladesh, Pakistan, Sri Lanka, all went into 2022 on a pretty weak economic footing, and they suffered significant consequences because of that. So because of the high commodity price, high inflation, etc., etc. So I think they really had their backs to the wall. Now, let's take the case for Sri Lanka. They really had no choice but to reform, and they are reforming now. So for them, from when I go on the ground and speak to people and for policymakers, etc., this time is different for them because even they had past IMF programs and they kind of then not done follow through on the reforms and things like that, and then again had to go to the IMF. But for Sri Lanka, especially this time, it seems different because they really had no choice but to reform. Plus, for example, historically, Sri Lanka, whenever they would go easy in the IMF program, they could go to the sovereign bond market, right? But now they defaulted. They cannot go back to the sovereign. They don't have a credit rating. They can't go back to the sovereign bond market.
Right.
So they have no choice but to reform and do follow through with all these difficult steps, which they have done. So the economy is recovering. And so they're okay now. And I don't think they will mess around too much with the IMF program or the reforms because, like I said, they cannot go back to the sovereign bond market for quite some time now. So it's not like they can go easy on the IMF reforms, don't take funds from IMF and then go to the sovereign bond market. That's what they did earlier. That's exactly what they did earlier. Now they have no choice. They cannot do that now. But Pakistan's situation, let's come to Bangladesh now. Bangladesh also was not is not in as bad a situation as Sri Lanka or Pakistan. But then again, they are doing the reforms which they have not done or imagined they would do maybe 2-3 years ago. So they just got the IMF second round, whatever the next round of funding just yesterday. And they took some very tough, they devalued the currency, they've liberalized interest rates. They're trying to reform other parts of the economy, remove subsidies. So they're also following through. And I think in Pakistan's case, yeah, I mean, you had these BoomBus Cycles, you had the IMF program. I think time will tell whether this time is different. But even in Pakistan's case, I think things really hit bottom last year, right? So there was talk of default last year, and then last minute you got the IMF standby arrangement. So I think I'm not sure. I cannot say for sure whether this time is different in Pakistan or not, but seems like it's moving in the right direction, and seems like everyone's on the same page. And also, again, Pakistan probably would need to follow through because given especially what's happened in the past couple of years and also their debt sustainability, I don't think they can go easy on the IMF program and then not take funds from IMF and go to the sovereign bond market so easily, or they have to pay a pretty high interest rate given what's happened in the past few years. So yeah, time will tell, but seems like in the right direction as of now.
There's a question, if you can, and like you earlier said, I mean, we don't have to do anything crazy. We just have to manage stability and obviously grow at a relatively decent pace. Assuming this happens, I mean, we don't try anything crazy. We grow at, somewhere between 4.5% GDP for the next 3 years. Things remain stable. We, introduce measures to address our fiscal imbalance. Because assuming this happens, what do you think is a fair market multiple that the PSX should be trading at then?
Yeah, I mean, if you look at the multiples, for example, in 2018, 19, when the crisis happened, Pakistan went from, I think, 8 or 9 times to, I think, 6 or 7 times, right? So something like that, basically. And people are saying it's cheap now. I remember looking at the charts and saying it's 6 times or 6.5 times in summer of 2019 that Pakistan is cheap now. And now you've gone from, I think when you had the rally during the pandemic because of low interest rates, you've gone from 7 times to, I think, 4 times.
Right.
So now it's even derated further. So it just shows how much lack of confidence investors have in the outlook of Pakistan because of the talks of default and political crisis and things like that. So it's got derated so much. So it just shows lack of confidence. So clearly, any incremental positives like IMF reforms, stable political growth, stable politics, stable economic growth, no macro crisis, these incremental positives will be extremely positive for the multiple, right? So you can easily go back from 4 times to 6 times at a start. That's 50% already, right? For a start. And that's if you take a probably 2-year view from here, right? And then if you don't have a BoomBus cycle for the next 5 years, that 6 can easily become 7 or 8, right? Because that's what I'm saying. That's when the foreigners will have confidence, right? So because even if you go from 4 to 6 for foreigner, 6 times is still so cheap compared to India, Vietnam, Thailand, even Sri Lanka is like 7-8 times now. So you're still so cheap. So then if you can show that sustained stability for that one economic cycle, basically, then then that 6 can easily go back to what was 8 times in 2018, 2019. Of course, in the previous cycle, you went to like 11 times, I think 10 times also, but that was because of the EM upgrade.
Right.
But if you now in this cycle, you can easily go from 4 to 6 if you sustain stability for the next 2 years. Beyond that, you can easily go back to 7 easily, but you have to sustain that basically. It's a big if, but yeah.
We don't have any more questions at this point.
Great. Ruchir, it was a pleasure having you. We don't want to keep you too late. We know it's getting late in Hong Kong, and we're very grateful to receive your views. Thank you so much for taking out the time for us today.
Yeah, thanks, Navi. Thanks to all your participants for joining and listening to my views, and really appreciate it. Look forward to being back, and let's hope we have some positive momentum in the Pakistan stock market to continue. And let's hope it continues for quite a few years now.
Let's hope so. Fingers crossed. And if anyone in the audience has any follow-up questions, or if we missed a question, please send those across to us, and we'll try to get Ruchir's view for you, if that's possible. Thank you so much, everyone. And thank you, Ruchir, once again, for taking out the time for us. I know it's late. Thank you, buddy.
Thanks. Thank you. Thanks, Navi. Thanks, everyone. Thanks.
Bye-bye.
Bye.